5 Smart Investing Principles. There's no shortage of self-help material available for people looking to boost their investing knowledge. Between television programs, magazines, and other information sources, you can read about the best of this, and the most important that. It can be easy to get confused, especially when you get conflicting ideas. Understanding a few key investment principles can be a great place for you to start. It can give you a better framework to understand the information as you take in the ideas. It can also provide you context for evaluating the concepts and strategies suggested. This video goes through 5 smart investing principles. These are key concepts that could help you understand what it takes to create an investment portfolio that is designed to pursue your investment goals. They're helpful to understand if you want to potentially break the cycle of buying high and selling low. Are there other investing principles? Absolutely. But for the purpose of today's video, we're going to focus on the 5 that we believe are the ones that are critical to understand. Keep in mind that the information in this material is not intended as tax or legal advice. It may not be used for the purpose of avoiding any federal tax penalties. And if you have any questions on this video, please feel free to reach out to us. We have professionals that can help you with that. Let's take a look at our first principle, estimating your time horizon. Generally, if your time horizon is short, you may be more comfortable with more conservative investing approach. Certain investments can be volatile and may not be appropriate if you have a short-term horizon. If your child is headed to college in 5 years, many people would say you have a midterm horizon. You may want to be less conservative with your investing approach and have a larger exposure to equity investments. When you have a long-term horizon, you may consider adopting a more aggressive approach. If you intend to retire in 10 to 15 years, having a larger exposure to stock investments may be more sensible. One way to lower your exposure to stock market risk is by investing for the long term, which gives you money to recover from periods of market fluctuations and loss. Of course, past performance is no guarantee of future results. Let's move from estimating your time frame to our next principle. Know your risk profile. How much tolerance do you have for risk? It's easy to say, I can handle high level of risk, but that may or may not be the case. It is a good idea to ask yourself some pointed questions and be honest with the answers. What happens to my outlook if the value of my investment drops? How much could I lose and stay in the market? It is also helpful to ask yourself, how would I describe my investment knowledge? There are some television programs that help people understand investments and the markets and how they work. But if most of your investment knowledge has come from television personalities, you really may want to consider getting a second opinion on your approach. Here is another helpful series of questions to ask yourself. What would you rather have? $500 right now or a 50% chance at $2,000? Many people go for the $2,000, and rightfully so. Since you have a 50-50 chance, a decision tree shows that a $2,000 answer carries a potential value of $1,000. But let's add a few zeros and see if that changes your perspective. What would you rather have? $50,000 right now or a 50% chance at $200,000? The decision tree says the opportunity to win $200,000 has the highest potential value. But in reality, many people second guess the decision because $50,000 is a lot of money. Remember, there is no correct answer for this question. This example simply helps you better understand the concept of risk. You see, investment risk can be managed, but it can't be eliminated entirely. All investments carry some level of risk, and in general, the greater the risk an investment carries, the higher its potential return. This illustration may help you understand how this all works. Along the horizontal axis is risk. The lowest level is on the left and the highest is on the right. Along the vertical axis is potential return. The lowest is at the bottom and the highest is on top. Different types of investments fall to different places on this graph. Keep in mind, however, that past performance does not guarantee future results. Actual results will vary. With the lowest risk and the lowest potential return are cash alternatives such as certificates of deposit, which are generally considered to be relatively safe investments. If you sell before a CD reaches maturity, you may be subject to penalties. Bank savings accounts and CDs are FDIC insured up to $250,000 per depositor per institution and generally provide a fixed rate of return. Traditional CDs offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with the changes in market conditions. Further up on the graph are debt instruments, such as government bonds. Debt instruments offer a slightly higher return, but at slightly higher risk. It is important to remember that bond prices, including on government bonds, rise and fall daily. If a bond is held to maturity, a bondholder will receive the interest payment due plus original principal, barring, of course, default by the issuer. Return of principal is not guaranteed. Next are stock investments, which offer the potential for higher return, but they can also have higher risk. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. At the top are the speculative tools. Speculative tools are not appropriate for every investor. They carry a high level of risk and, when sold, may have a little or no value. You see, risk can come from different sources. For example, there are external risks that may influence the price of a stock. That is the source of the risk that are outside a company's influence. These may include economic risk, market risk, interest rate risk, political risk, and tax risk. Let's take a closer look at one of those risks, market risk. If the overall stock market trends lower, many stock prices would be expected to trend lower as well. Conversely, if the market trends higher, many stock prices may move higher. It's all like the old expression, a rising tide lifts all boats. On the other side of the scale are company-specific risks. These are risks that are unique to the company, such as delayed product launch, unexpected expenses, supplier problems, and a management shakeup. These are just examples. By buying a stock in an individual company, you're agreeing to accept a certain amount of company-specific risk. Next is investment principal diversification. Diversification suggests that a portfolio of different kinds of investments on average may potentially yield a higher return and pose less risk than an individual investment. In short, diversification helps you manage the company's specific risk we illustrated on the previous image. Let's assume we have an investor who has $750,000 to invest. On the left is a hypothetical example of $750,000 placed into a single investment. On the right is a hypothetical example of the same amount divided between 3 investments. Remember, diversification is an approach to help manage the investment risk. It does not eliminate the risk of loss if a security price declines. After 20 years, the single investment, assuming a 5% return, will have grown to roughly $2 million. During the same period, our diversified portfolio will have grown to just over $2 million. And in this example, we're assuming that one of the investments was a total loss. That is, it was worth nothing at the end of the 20 years. There is more to diversification than simply spreading your money around to different investments. In principle, you want to select investments that have low correlation with each other. That is, investments that don't tend to behave the same in a market environment. One measure of correlation is called the beta. Beta is a measure of stock's correlation with the overall stock market. Beta is a measure of how likely a stock is to move up and down as the overall stock market moves up and down as well. In this example, we're using the S&P 500 Composite Index Total Return to represent the market. So it has a beta of 1. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market. Keep in mind, index performance is not indicative of the past performance of a particular investment. Individuals cannot invest directly in an index. A stock price that varies more widely than the S&P 500 would be expected to have a beta that is greater than 1. A stock with a beta of 2, for example, will rise and fall, on average by twice as much as the wider stock market. So if the S&P 500 falls by a hypothetical 1%, a stock with a beta of 2 would be expected to drop by 2%. Beta can also be negative. For example, a stock with a beta of -1 would be expected to see its value fall by 1% when the market rises by 1%. Another investing principle is the consideration of taxes and inflation. This chart shows how many days the average American will work in 2018 to pay their tax obligation. Americans pay income taxes, Social Security taxes, sales and excise taxes, and property taxes. The same concept occurs when you put your money to work. Taxes may take part of your return. So when you're looking at the return of an investment, ask yourself, what is my return after taxes? Another silent thief you have to watch out for is the effect of rising prices, otherwise known as inflation. Over the long term, inflation erodes the purchasing power of your income and wealth. It is easy to see. Just look around from 1967. In 1967, new house cost was about $14,250. Income was about $7,300 per year. A gallon of gas cost about 33 cents. And the average cost of a new car was about $2,750. In 2017, the average price of a new home was just under $403,000. The median household income was just over $61,000 per year. The average prices for a gallon of gas was $2.42, and the average price of a new car was $36,000, just over that. Our last investment principle is get started now. Procrastination can be costly. For example, if you are to deposit $250,000 in an account earning 6%, At the end of 20 years, your account would have been worth just over $800,000. If you waited 5 years before starting your investment program, the $250,000 would have 15 years to work and would have grown to just under $600,000. And if you waited 10 years and then started your program, you'd only end up with almost $447,000. To put it another way, waiting 10 years to start was a $350,000 decision. Keep in mind, this is a hypothetical example, used for illustration purposes only. It is not representative of any specific investment or a combination of investments. When you're ready to move forward, we identified some specific action items to help you get started. First, put together a personal income statement. You want to identify all of your sources of income and where your money is going. Next, put together a simple balance sheet. This should give you a good snapshot of your assets and liabilities. Identify your long-term, medium-term, and short-term financial goals. Then be honest with yourself about your tolerance for risk. Can you stomach big market swings, or are you more comfortable with less volatility? Once you've sized up your personal finances, it may be beneficial for you to talk to us and review if your risk tolerance matches your portfolio. Our contact information is on the screen and in the description. So let's review the 5 smart investing principles. First, estimate your time horizon. Is your investment horizon 3 years or 30 years? Second, know your risk profile. Can you tolerate big swings in the value of your investments? Or do you prefer less volatility? Knowing your risk profile is an important step as you consider various types of investments. Third, diversify. This is so important that we listed it 3 times. Fourth, consider the effect of taxes and inflation. And finally, get started now. Take the initiative and get going. If you learn nothing else today, please understand the importance of getting started now. When it comes to pursuing investment goals, the more time you have, the better. Again, keep in mind that diversified portfolios does not assure a profit or protect against loss in a declining market. Following a few smart investment principles can make your investment efforts much more effective. But it doesn't end there. Effective investing requires an ongoing effort, and there's a lot more to know. Here are some questions that arise at different stages of life. Anthony and Selena have a growing family and wonder, what's the best way to fund our children's college education? Dave and Christine are in retirement. They ask, should we change the allocation of the portfolio now that we're no longer working? Rebecca is a single woman with a small business. She wants to know, my business is finally doing well. What is the best way to put my extra income to work for my family's future? Isaac likes to do research online. He asks, does it make sense to watch the markets every day and trade on what happens there? Answers will depend on each unique situation. There are a number of strategies you can use to attempt to invest wisely. And that's where we come in. We specialize in helping people just like you set up investment strategies that help them pursue their investment objectives. If you're ready to take a fresh look at your investment portfolio, feel free to contact us. To help you learn more about investing, I have a webinar on investment strategies for volatile and uncertain markets. The webinar link is in the description. Your plans for the future shouldn't be dependent on daily fluctuations in the stock market. Gains and losses are part of investing. By using a deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to constantly adjust your portfolio to react to today's news. Again, the webinar link is at the bottom. Click on it and we'll see you there.